And with that, I would love to bring on our team from CalNonprofits Insurance Services, Colleen Lazanich. She's the CEO of CalNonprofits Insurance Services, Cole Kinney, the Senior Vice President of Development, and Amy Neuman, the Senior Vice President of Property and Casualty. We're so happy to have you all here today. This is a really important topic. I know there's been a lot going on in this space recently, so this is a timely and important webinar, and we're really happy to have you sharing your expertise with our members. So I will let you all take it away.
Thank you, Robert, and welcome to everyone who's on the call. We've seen a lot of clients and familiar names popping up in the chat, and we're happy to see you, as well as all of you that we don't know yet. Robert did a great job of introducing our team. I'd just like to explain just super briefly that CalNonprofits Insurance Services is a subsidiary of CalNonprofits, and if you were on our member webinar, you will see that you will have seen that the majority of our profits go to support the advocacy and policy and research work that CalNonprofits does to help benefit the overall nonprofit community. Robert did a great job introducing us. Do either of you have anything you'd like to say before we kick off the webinar?
I'm really happy to be here. I know so many of you that I saw that registered for the conference, so we're really happy to be here.
Likewise, Amy Neuman, newer to CalNonprofits, but not new to the insurance industry. And we were just talking yesterday about our combined tenure in the industry is over, I think we came to 113 years combined between the three of us. I won't share who probably has the most experience, but it's not me. I'm only 30. 30 years, not 30 years old.
Great. Next slide, Robert. Thank you. Who we are, and this is so often misunderstood. Your broker, that's who we are. CalNonprofits Insurance Services, they're in the middle. We're your representative. We're your advocate to all of the insurance options that exist, and that's everything that's showing to the right there. Insurance carriers, sometimes we have to go through wholesalers to reach certain carriers, or excess and surplus insurance, to your risk retention groups, and all of those kind of behind the scenes of all of that are reinsurers. And the reason I'm including them on this slide is because we're going to be talking about some of the impacts that you see as a consumer of insurance, both personally and for your nonprofit, are driven by all the way back through the reinsurance situation. And so we're representative. We're going to stress that because so often people think that we're the carriers, that we're setting the rates, that we are doing the ones making the decisions whether to insure them or not. And that really isn't the case. We're out there trying to find the best insurance that we can for your unique exposures, which in nonprofits run the gamut. If you just insure, say, restaurants, you're going to know all those exposures that happen in a restaurant. But if you're insuring nonprofits, you're covering everything from a restaurant exposure, oftentimes, to builders, to daycares, to pretty much anything you can imagine happens in the nonprofit space at some level. So that can be pretty complex. Next slide.
So we know a lot of you are really facing some difficult times related to insurance, general funding, all kinds of things. We talk to folks every single day. I can say, doing this business for as much as I have, I might be one of the oldest people doing insurance on this panel, but I can definitely say that this is a hard market like we've seen in the past that we're going into. We're seeing rates increase. We're seeing coverages decrease or go away. So that's the kind of the thing we want to share with you overall, is to let you know what the landscape is, where we see it going, and then we're going to give you some good solutions or recommendations on how you can kind of mitigate through that whole process as we go through this webinar. So Colleen and Amy, take it away.
Yeah, so as Cole mentioned, premiums have been surging. These numbers of 200 to 1800% is really like since 2019, we've seen year over year increases happening. This year, we're seeing average increases between 8 and 20%, depending on the lines of coverage. And if you have losses, and we'll be talking more in depth about this, it could even be higher than that. The one soft spot has really been workers' compensation, but as Amy's going to share, we're seeing pretty much some of our first overall rate increases in workers' comp starting to hit our marketplace.
Yeah, the California just approved the first overall work comp rate increase in 10 years. The Workers' Comp Insurance Rating Bureau is projecting that there's going to be a combined ratio of 127%, which is the highest since 2001, which is being driven sharply. And we're going to talk more about this. Increasing medical costs, the loss adjustment expenses, and cumulative trauma. Those are like your overuse of your risks like carpal tunnel, cumulative trauma claims, and then of course litigated claims are rising fast, and then those are costing more. So we were enjoying for the last 10 years a really soft market, but we're going to start to see that change.
And I believe that change is about 8.2% is what the Bureau announced. Is that right?
They did. Now each carrier will adopt that at different levels and depending on the class code. So when you hear an average like that, that could be some classes going up really high and other classes not having an increase or having a lesser increase. But yeah, I believe that average was 8.2%. And then also just a quick definition of combined ratio. So combined ratio, when insurance companies talk about their losses, they're going to talk about a combined ratio. And if it's over 100%, it means they're not profitable. So the combined ratio is where they're combining the cost of claims and the expenses of providing other expenses providing insurance all together. And then they come up with their combined ratio of profitability. And so they're expecting the overall workers' comp market to be 127%, as Amy said.
So I just wanted to restate too, this only applies to California at this point. We haven't heard about increases in other states, but there was a question in the chat here in the Q&A. If we have volunteers, do we need workers' compensation? No, volunteers are not required to be covered by workers' comp. You can include workers' comp for volunteers or get a volunteer accident policy, which would essentially give them some benefit, and it's usually much less expensive. So that was normally what we would recommend, is looking at getting a volunteer accident policy in lieu of insuring them under workers' comp.
Yeah.
Good question.
So, and at the same time as this, expenses are going up, and some of those expenses are causing insurers to withdraw from certain markets. California has a reputation of being one of the more difficult marketplaces to do business in. And we're actually going to dive into that a little deeper, and or reduce their limits. Especially, we're seeing decreases in excess liability and or non-renewal. So excess being your umbrella policy or standalone excess policy. And then in California, some specialized risks like wildfire and some types of liability claims for certain sensitive services have been making traditional insurers pull back from the marketplace. And so even if they're still in the state, they're not writing new business of certain classifications. Next slide.
Real quick, there's a couple more questions that popped up. One was on the proportion of total premiums and paid claims. That's going to probably be something we'll have to get back to you on. I don't think we have that data here, but someone else asked about 1099 contractors and workers' comp. Now, there was a law that was passed a few years ago in California called AB5. So it does require certain 1099 contractors to be insured by your workers' comp. They could fall like when the arts organization, like museums, things like that. So if you need more information on that, either refer to the AB5 rule or contact us and we can give you more information about that.
So, we mentioned why, or we mentioned that coverage is tightening. Now we wanted to talk about more specifically about some of the drivers and the impacts that those drivers are having on the marketplace. The severity and frequency of natural disasters, and this is nationally has increased. And so in California and in the West in general has been these catastrophic wildfire losses. The estimates for the January fires from earlier this year in Southern California are that they're going to exceed $250 billion. And I know as we talk about these numbers, they kind of seem like not real numbers. Like you see 250, okay, that doesn't seem that's a lot. So, but there's a lot of regulatory constraints happening on that are causing some of these premium increases, as well as just all costs in general. I mean, we all know this from our daily lives, right? Everything is costing us more. Vehicles cost more. We pay more for our employees. The medical costs are going up. The building costs, if you have to rebuild something, are going up. So we know this all from our normal lives, and that's going to affect insurance. That's going to be a driver in the costs going up. And if they can't get commensurate rates, that's the impact that it's going to have on the marketplace, is that they're not going to write the coverage, or they're going to restrict the limits. Litigation's been rising, and there's a lot of inflation in healthcare and legal settlements. And that drives capacity reduction has been driven by the reinsurance. When we say capacity reduction, it's like they're not going to let companies cover certain things. So the overall impact of those is that it reduces the insurer's appetite. If they can't get adequate rates, they're not going to cover the risks. There's some legislative changes that we'll talk about on the next slide that could shine a light at the end of the tunnel. How long that tunnel is, we don't know. I wish we had a crystal ball to predict that. But it also has causing removal of certain coverages. It used to be we'd see riot and civil commotion exclusions on very rarely on policies like this, but we're seeing some carriers putting that on every policy now. Wage and hour defense is being reduced or taken off of coverages. There used to be a carrier that would include that on almost all policies, and now you have to apply separately for it, and they may not give you the limits that they used to give you for those. We're seeing the reductions in limits, especially around higher limits for excess and umbrella. At the same time, your contracts are still going to require you to carry certain limits, and your funding contracts and your funding sources are going to require that. We're seeing a bigger reliance of use of California Fair Plan to cover fire losses, and financial instability for nonprofits.
One of the tactics.
Yeah.
Sorry,
someone made a comment. Sorry, someone just made a comment about insurers are withdrawing and limits are being reduced, and some are not renewing. So I'll just state, I haven't seen a lot of insurance companies withdrawing from the state specifically, but they are reducing their appetite. Like Colleen said, they're not writing certain risks any longer. Organizations that do fiscal sponsorship, for example, the market's very, very limited. There's one primary carrier doing that, and some will entertain some Model A fiscal sponsorship, but very little. That whole market on the fiscal sponsorship side is definitely reducing, or almost gone in some areas, where some carriers used to do that and they're just not doing it any longer. But luckily there are certain carriers that still have a hearty appetite for it, but are restricting the kinds of Model A projects they're writing.
That is a good segue too, in terms of the carriers reserving either capacity, or instead of non-renewing, they're applying deductibles. Like, for example, we'll see that on the auto, if you've got a large fleet, you might start seeing, you know, a deductible added to both the physical damage of the vehicle and also the auto liability, which is actually a positive instead of them non-renewing. So, and that could also be a tactic that we could talk about later in terms of how to help offset cost increases.
And you know, we've done webinars just on like situations around the directors and officers insurance, and I know there's always a lot of questions on that, which directors and officers is often combined with the employment practices, which might include the wage and hour defense. And what we're seeing is that the claims are increasing on that. I mean, the last statistic, which was from years ago, was that over 60% of nonprofits will experience a claim against their D&O policy. And I believe that number is higher, but I couldn't find any actual statistics that anyone's published. I just have heard it at many, many carrier meetings where they're talking about that they are seeing claims going up and those claims costing more money, and especially against nonprofits, more than private corporations or even public corporation lawsuits. That it's increasing.
So there's different questions coming up. One question just came up about Model A fiscal sponsors. I think it'd be better to just contact us directly. So there's going to be our contact information at the end of this presentation, but that's a specific thing. But in general, fiscal sponsorship coverage is definitely available. And we're not seeing that necessarily going away anytime soon. It's still a very viable coverage for one particular company to write. It's just being more difficult for other carriers to write that type of coverage, and their appetite on the types of Model A projects that you may be working with may be changed in the future. But it doesn't mean that they're not able to work with you to essentially find other creative ways to manage that risk.
And also, I'll just put a plug in, CalNonprofits on their resources of prior webinars. They have the webinar that we participated in, along with an attorney, because a lot of fiscal sponsorship questions come up that are more legal driven. And Cole and I have participated in a number of them. We can have an entire hour plus talking about fiscal sponsorship and some of the issues specific to fiscal sponsorship. So, yeah. Was there another question, Cole, before we move on?
Yeah, there's another question
legislative?
It's not legislative. Well, the question's related to the types of insurance for nonprofits. I think we can maybe just put in a link to our website that just describes the different types of coverages. But essentially, all nonprofits need at least general liability. General liability is going to be bodily injury and property damage to a third party. That's required by most contracts. If you have a lease space, or if you're just doing anything in the community, or lease your own space, or doing anything in the community, you need general liability, hands down. The second would be professional liability or abuse liability if you work providing a professional service, or you work with a vulnerable population. So that could be the elderly, youth, disabled, that kind of thing. Again, those things can also be required by written contracts. So that's going to be something definitely you'll need to consider. Also things like business auto. If you don't have any owned or leased autos, you might want to just consider getting what's called hired or non-owned auto liability. So that would be like vehicles you may rent, or anyone using their personal vehicle on behalf of the organization. The non-owned and auto liability would count for that. Workers' compensation is a mandatory requirement that if you have just one paid staff member, you have to have that. Again, you don't have to have it if you don't have paid staff. And then you might want to consider things like cyber liability, which is, I believe everybody has an exposure to cyber liability. Premiums are not that expensive for that. They start at a pretty low amount based upon the limit and what your size of organization is. But other things like property coverage, crime, any kind of bonding, gosh, there's so many. Directors and officers liability coverage.
And officers is one.
Yeah, definitely that. The directors and officers liability is essentially liability for board governance. But then, like Colleen said, those kind of policies can include employment practices liability, which would be claims like wrongful termination, discrimination, harassment. Those claims can come from an employee or even a third party you contract with. And the policies also for D&O cover things like fiduciary liability. So you act as a fiduciary on behalf of employees when you place benefits, even though you may use a third party. So those are just kind of a sample of the most common coverages that we see nonprofits have. But they could be generated by the exposure that you have, but also by contracts requiring those insurance limits or insurance and specific limits to be funded.
I also saw in the chat around employee benefits plans and trends. And while we weren't going to specifically talk about the cost, those ranges that we gave at the very beginning are what we are also seeing on employee benefits plan increases this year. And in fact, this is the first year in many years we're seeing a pretty much across the board double-digit increases. And I'm talking about going into 2026 because that's the renewal season that we're in right now. We're seeing on the employee benefits plans, not a restriction of coverage, not coverage tightening or some of these other legislative things that that we're talking about right now, but we are seeing, because healthcare and medical costs are increasing so rapidly, there is rising litigation and inflation in those costs, and that is going to cause benefit plans to increase in pricing also. But around the same percentages, 8 to 20% are what we're starting to see. The rates for renewals, which most policies are renewing in December and January for benefits, or the vast majority renew around that time. So we're talking about 2026 rates by and large. Most of those are being hit by those numbers in that range right now.
I mean, there was one more question about organizations that work with animals or animal shelters or fostering, things like that. The insurance market is definitely tightening up on this particular type of risk. Some insurance companies used to write this all the time are now pulling back. They're not writing it any longer. And it's all due to claims. We have a rescue organization that we just we saw a carrier non-renew them because they had a situation where they were displaying some animals or having some animals up for adoption at a shopping center, and a little kid came up and the dog bit the kid's face, and it was like over a $500,000 claim. So that's why it's just too costly for the premium the insurance companies can get. It doesn't mean that the coverage isn't available. It's just more restrictive, so it's harder to get. So again, at the end of this webinar, there's going to be information on our contact information that you can reach out to us and ask us specific questions like that, or markets that we could help you with.
Next slide. So I did mention there was a light far down at the tunnel starting to shine. There have been some recent legislative changes, some recent reforms. So just this past July, just about a little over a month ago, Insurance Commissioner Lara finally announced that he was finalizing the sustainable insurance strategy. So a little background on that is that every other state in this country allows insurers, when they've set their rates that they're going to charge, they have to file those rates with the Department of Insurance in each state. Every other state besides California allowed insurers to take into account catastrophe modeling, so how likely these catastrophes are to hit in their areas, and reinsurance costs. So if the reinsurers are raising rates, they were able to take that into account when they filed a rate. California did not. And because of that, this is why if you own a home or have an auto, you probably have seen carriers pulling completely out of the state. What we're seeing on our side because of that is the unwillingness to write new insurance in the state, and the unwillingness to write coverage and to add more of these exclusions like we were just talking about earlier. So this we don't yet know how long the impact of this is going to take, this sustainable insurance strategy, but it really does affect every one of us from a personal and a professional level, because we all have, usually most of us will have a home and or auto insurance on that side, and that's become really, really difficult. And we have that here. The cost of living in California is higher than a lot of other states, and yet we actually pay less insurance than other states pay for the same homeowners coverage and auto insurance coverage and building coverage for commercial buildings and liability costs for our insurance. And so these new regulations will mean that insurers may file higher rates, but it means they're going to stay in the state or come back into the state. And so part of this second bullet point here is that regulation would require them to start to cover, if they're going to file for a rate increase, say in their property insurance, to cover wildfire prone areas or don't operate in California. So some of these are going to see some potential return of carriers to the state, or willingness, if they've backed off writing new business, willingness to start to write new business, giving them some greater pricing flexibility. And so it is important to stay informed and engaged in some of those advocacy efforts. There's a lot of consumer advocacy happening. You're consumers, we're consumers, we pay insurance in our lives too. And so it affects all of us. And then PAGA suits, which we didn't really touch on the prior slide. There were some PAGA suits, which is the Private Attorneys General Act. And I'm going to let Cole talk a little bit about PAGA and some of the effects that we're seeing on insurance, because this is causing issues for us on the employment practices liability space.
So PAGA is essentially all related to wage and hour issues. You only need one person to create a class action suit in this whole world, which makes no sense to me personally, but that's a big thing. I know the association, and Robert, you can speak to this if you like, but the association really tried hard last year to relax the PAGA requirements to create a claim. Unfortunately, due to the fact that so many of the legislators that oversee that are all attorneys themselves, we didn't go too far on that. There is a new attempt to basically try to get that squashed again, because it doesn't really seem to have a positive effect for employers, any employer in California. It was enacted back in 2004. In the 20 plus years that this has happened, all it's done is cost employers a ton of money, and it's basically fines the state is imposing. So if you can get wage and hour defense added to your directors and officers liability policy through the employment practices coverage on that form, please try to do it. Certain insurance companies, like Colleen mentioned, require now that you have to complete an application to be able to get that. So whatever you can get, it would be good, because in many cases what happens is that you let somebody go for cause, they retaliate, get an attorney to defend them, and the attorney will just throw all these things at you to basically say that you did something to violate the wage and hour law. So having this coverage for defense only at least gives you that, because they may also bring allegations like wrongful termination or discrimination, something like that. But if they add this wage and hour piece, that part won't be defended. You'll have to get your own attorney to defend you for that part specific, but the insurance company would defend you for the other things that their coverage does provide. So if you can get them to provide you with that defense, they can at least get one attorney to defend you for everything. The sad thing that's happening is that we're seeing the coverage being added, but with really high retentions or deductibles. So the best thing is at least to have the defense coverage there. It won't pay for any damages. So if you do get fined from the state, whatever that amount is, none of those are insurable. The only thing that they do insure is defense. So really try hard to get that coverage on your employment practices coverage of your D&O policy, if at all possible.
Yeah, and as Jeff said, Jeff Green at CalNonprofits has been really involved in this, as Cole just mentioned. And the final form of the reform legislation last year did really little to fix it. Lawsuits against smaller nonprofits are growing. We're seeing them like going and finding more of them. What the association is doing is taking part in, as Jeff, and there's air quotes around this because he actually put quotes around it, and when he sent to us was a coalition of the willing. So those willing to work on trying to get some reform legislation done. So and they have engaged an attorney to assist in that process. So that's ongoing and still more to come. Some lights, like I said, far down the tunnel. Next slide.
So here's some ways that you basically can avoid all these claims. So having a risk management program is really, really essential. Especially like we talked about the wage and hour coverage, having things like a wage and hour audit done. You can work with your attorney or your CPAs to help with this kind of thing. It really helps business comply, make sure they're complying with all the latest laws related to wage and hour. It checks payroll practices to align with regulations like the Fair Labor Standards Act, and the audit aims to identify potential wage and hour violations so that you can avoid those, period. And a key part of the audit is reviewing the company policies for compliance with current labor laws. So having those types of audits is really, really critical. Your insurance carriers also have a ton of risk management resources. Their goal is to help you not have a claim. So you can check with your insurance companies because they may have really good resources around any type of risk management, whether it be slip and fall, defensive driver training, workers' compensation safety, building or facility safety. All those kind of things are complementary services provided by your insurance carriers. They even provide services related to things like sexual abuse prevention. So if you are an organization that have to provide sexual abuse training to your staff, the insurance companies actually offer that training. They even offer things like vehicle telematics services, which are like gizmos you can put in your vehicles to basically, track the vehicles, see how fast they're going, where they are. Those are really good tools. Like if you had a serious accident in the community, or if there was maybe a disaster that happened, you'd be able to locate the people in your insured vehicles, things like that. But doing regular risk audits is really, really essential. So evaluating your exposure, seeing how your insurance policies respond to those exposures, really looking at the policy forms of your different liability policies to see the exclusions that are included. So like Colleen mentioned earlier, that we're seeing a lot of insurance companies now put on a riot and civil commotion exclusion. Now with what's going on in our country, with a lot of people going out to protest, those kind of exposures aren't covered by your policies. So make sure that you understand that. And so that if you do have any kind of, if you're encouraging people to protest or whatever, really consult with your insurance broker to see how that coverage may be not included on your current insurance if you do get sued or anything like that. And then prioritize high impact exposures, again, like the wage and hour audits, and really do an in-depth review of contracts. We review a lot of contracts. We're not attorneys, but we're used to seeing insurance contracts. We love to see those before you sign them. So if you'd like to forward those on to your representatives here at CalNonprofits, if you're one of our clients, we can review those for you and let you know what insurance you have in place and if it complies with that requirement, or what insurance coverages they're maybe asking for that aren't even really an exposure that you have. So maybe you can push back on those, see if you can get those eliminated. Or in many cases, what happens is that they require higher limits than you have. So as we mentioned earlier, umbrella and excess limits are being decreased. And the main reason for that is because of court judgments. What we're seeing now is that juries are actually awarding full insurance limits rather than the true merits of the case being awarded. They're just awarding full insurance limits. So that's why insurance companies are decreasing those limits, and it's happening across the board. So making sure that you can maybe push back on some of those higher limits to see if you can work with that, because once that contract is signed, you're obligated. And then you'll have to get your insurance company to or broker to try to make sure that they're complying with all those things. Again, get involved with legislative reform. Can't stress that enough. And then some of the things that we're seeing now that rates are increasing, especially on the workers' comp side. Several years ago, there were different risk pools and self-insurance groups that were formed. Those are going to probably come back into play again. There's one company that we work with a lot called the Nonprofits United. They have a risk pool for auto insurance as well as workers' compensation. They have a group self-insurance program for that. Their rates are very competitive, but sometimes not as competitive as the standard market. So there's two real, like in workers' comp, there's guaranteed costs, which is, you go out to an insurance company, you get an insurance policy for workers' comp, you pay a premium. If you have whatever amount of claims, they pay that. They don't increase your rate. The only reason that you'd get an increased bill at the end of the year is if you estimated your payroll lower than what the audited exposure was. So they'll audit your payroll at the end of the policy term. And if you estimated lower than what your actual audit amounts were, they'll charge you an additional premium. Sometimes they'll even add class codes because maybe you didn't disclose that you have a new program that has a different kind of exposure. So they may add different class codes, which may have a higher rate. That would be the only reason your premium could change. But with these risk pools, that's not how it works. So basically what they do is that they'll establish what's called a loss fund for each year. So they look at all the organizations that are involved in that group, and they establish a risk or loss fund based upon an evaluation of all their claims and premiums or contributions, they call them, into the program. And so that loss fund is established for each policy term. And if that loss fund is ever exceeded, then you as a member of that group will become joint and severally liable for your proportionate share of whatever that loss fund exceeded amount was. So this could happen like 5 years from now. So say you have a policy that goes from January to January, and then 5 years from now, this insurance company you're with comes back and says, oh, our loss fund was exceeded. Now we're going to bill you X amount of dollars because you are a member of the group and you have to pay for that. Under a guaranteed cost program for workers' comp, that's not allowed. They won't do that. You pay the premium. If they didn't renew you, or if you went to another insurance carrier, they can't come back and assess you additional premiums because they may have had a bad loss year for that particular year. Okay, so understand the pros and cons of getting into these kinds of groups, and then also understand how to exit them. Because in many cases, they require a very large notice, like at least 6 months to exit the program. So you can't just say, oh, I found a better deal and I want to move. You can't leave. You'll sign an agreement at the onset of this program that in many cases your board has to sign off on to enter the program. So really understand those risks and benefits before you get into any kind of captive self-insured group, or JPA is a joint powers authority. You see those a lot, like in schools, especially charter schools have created these kind of programs that are really sometimes very competitive, but you have to be wary because what they do is that they have these high limits, but those limits are combined for everybody in the group. So if there's a serious loss, your limits could be eroded. So really understand those kinds of programs before you get into them, because usually you're going to be locked in for a certain amount of time. For example, on the captives and self-insurance groups, you're locked in for a period of time, sometimes 3 years before you can exit. Okay. See if there's any questions. Yeah, there was a question about affordable housing. This is a great question. Our buildings are over 100 years old. We're trying to upgrade our infrastructure at the same time as our insurance costs are going up because we are being placed with a smaller pool of insurance. Can you advise how we can get into a larger pool? Okay, great question. So older buildings are always going to be a problem. The most important thing with older buildings is to make sure that they're updated. So especially for housing, it's so critical for insurance companies that housing units are fully sprinklered, so a wet sprinkler system in the event of a fire loss, not just in like the basement, for example. It should be fully sprinklered building. And they're just problematic because they're multi-story. if the elevators go out or, getting out of the building is difficult, that's a high risk. So making sure that the buildings are properly updated is the number one thing. So getting, retrofitted, getting plumbing updated, electrical, roofing, all those kind of things is super critical. A lot of insurance companies will take 100-year plus buildings. They'll make you complete a questionnaire that asks all those kind of things that some of the things that I'm referring to, like when the building was updated. If you're doing those things, you'll be able to get insurers to consider working with you because they are willing to take on those risks as long as they can get the rate for them. They'll probably put on a very high retention or deductible. So those will maybe go up to like $10,000 or even higher. But they'll be able to insure you for the proper value of that building. Because what's happening probably with a lot of the groups like yours is that you're having to go with multiple insurance companies. So they layer the policy. So they say this one insurance company will take the first 500,000, this other one will take the next whatever. And so you end up having multiple insurance policies for one building. And that's really problematic. It's very expensive as well. So doing those updates is really the most critical part to keeping the cost down as low as possible.
Nicole, another
Oh,
question.
and
We have 2 more slides too.
Yeah, and
we're at, yeah.
I would just say on the other housing question, just refer to our emails and you can ask those specific. Go ahead.
Yeah. So on this slide though, specifically, and yeah, we do have 2 more slides to get through super quick, but do insurance policies help with risk audits, or do you have suggestions on how to pick a good risk auditor?
Yeah, I would definitely say talk to your attorneys or CPAs on that, because they'd be the best people to connect with regarding those, or even an attorney, especially attorney that specializes in payroll. Those would be the most important folks to connect with. The insurance companies, I haven't seen a lot of risk management tools specifically related to this. I think they have those that are going to be for facilities, for employee safety, vehicle safety, things like that. But I haven't seen anything related to wage and hour from an insurance company.
Okay, let's get into our practical guidance for renewals really quick. And then I'm sure this is going to open up even more questions. So,
Did you want to take the first part or you want me to, Colleen?
sure. So, ideally you want to engage your broker 90 to 120 days before. If not, even sometimes we are meeting with people even a little earlier than that. You have to have a good idea of your organization's risk tolerance, especially if you're making any changes around that. But one of the best things that you can do, like I said, is your broker needs as much information as possible to prevent the best possible risk profile to the carriers that they're trying to get your coverage through. So make sure you're sharing any mitigation efforts, risk management, or loss control that you're taking. If you've had any claims, and specifically if you've had more than one claim or you've had a really bad claim, and you've identified any ways to prevent or reduce future claims, like, oh, it was a breakdown in our processes, so now we're doing this training. Share that information. We need to know that I'm talking about all brokers, even if we're not your broker. Your broker needs to know that. And that's what they should be doing. So
that's right, Colleen. And as you mentioned, our job as brokers is to present you in the very best light. So if you give us the big, bad, and ugly, then we're going to take that information. We're going to create the story. We know how the underwriters are thinking. When I say we, I'm speaking on behalf of all brokers, most brokers. But we take that information, we create the story, and then we fill in the blanks on where the underwriter might be thinking that there's a concern or where they want to draw attention to. So the more we know, the more then we can ask you to help us present the best scenarios.
Yeah, I would say too, especially related to claims. So for example, if an organization has had a lot of employment related liability claims, talk about what you're doing now to prevent those. So like if you're the average turnover rate is like 25%, maybe yours is higher than that. What have you done to do better hiring practices or whatever to avoid those claims.
That's a good point. And one of the benefits of working with a broker that's focusing on nonprofits is that we organically start to aggregate data and information and can piece together the similarities of the organizations and bring back to you, solutions or ideas or what others are in your space are doing. So maybe like Cole was talking about claims mitigation, and you're not really sure how to proceed. We and brokers that focus in this area can provide that guidance. And then when it comes to the process for the insurance, every year we're collecting information, and I feel like that's the hardest part, is to take all that data that we need so that we can create the story. But some tips and tricks around that is to collaborate with your broker. It's not just one way of gathering this information. So if you are feeling like, basically don't be afraid to speak up and say, hey, the way this is going isn't working as well. I would prefer we do it during X time of the year. Maybe we need to move the renewal dates. Or maybe we need to start even earlier. And at CalNonprofits, we like to be, 90 days into the marketplace, ideally. But don't be afraid to speak up and say that there's maybe a better way. One of the things that I like to do with my clients is to provide a list of the key data pieces that are going to really move the needle on the insurance, either from a premium standpoint or a coverage standpoint, and give that list of those data points. And then together we get on the phone and we work through the application, setting aside an hour or less. But if you're new to insurance, or you've taken on a role that includes insurance now, that happens a lot, this would be a great time to work with your broker to go through the applications, because you'll then get an understanding of what is it that the question is really meaning. And then we can talk through the answers. Sometimes you probably feel like you're answering a question and you have no idea what that really is going to do. What lever is that going to pull? And so that's a great time to collaborate with your broker. And also, take advantage of technology. So if you are working with a broker that's got the technology, use that for the applications. We internally have a really great system. But if you're working with a broker that doesn't have the technology to expedite the insurance process or application process, then ask them for, the key data points that you need to gather, so that you're not having to flip between applications and grab this and grab that. And then if your program is a little bit more simple, you might consider just telling your broker, you know what, we're going to be, unfortunately, and with all of the funding challenges, you might say, hey, we're going to be 10% less in, our payroll, or, just apply a percentage. And the brokers can take that and apply that to get that out to market. But if you're more complex, you have a more complex program or a larger program, you should be expecting to hear from your broker to have a pre-renewal strategy. And that's generally happening in the 90 to 120 days, where you're talking through what are the challenges in the market, what should we be budgeting, what information are we going to need, and that's another time when you'll be talking through what Colleen mentioned about some of the things that you might be changing in the future. So, but that information really helps. That renewal process, pre-renewal meeting really helps set the stage. And then it also sets the timing, when do you want the presentation? When should we be presenting? And then lastly, a bulk of nonprofits renew in July 1, which puts a lot of pressure on the insurance industry. So if your broker's asking, for something that seems exceptionally early, it's because they're trying to get out in front of the underwriters and give you the best opportunity with where the underwriters are not so exhausted and stressed. So be mindful of the timeline. And if you can't meet it, connect with your broker and find out what's the critical information that's going to get you your applications to market. Next slide.
So as you've already heard us mention, we are a subsidiary of the association. We're appointed with over 100 carriers. We have exclusive nonprofit programs on benefits, and and deep expertise among our team of nonprofit specific risk management and tools. We also offer access to a range of resources and software. I just answered a question in the Q&A I referred them to Mineral, because Mineral, which is provided as a member and or client of CalNonprofits, is a great resource for compliance and regulatory update and protecting your organization from some of these employment practices. What do I do in this situation? As well as having live advisors to answer some of these more HR related questions and where do we go. They also have workplace and safety videos available for training and bolstering that whole thing. We also have our savings guide. We now have a discount to Grant Station as part of that savings guide. Savings guide also includes some other organizations such as Taproot. If you're not familiar with them, they have a lot of professionals that'll provide some pro bono services to nonprofits. So check out the savings guide and our resources. And so I think we did take questions during, so we ran a little over on that presentation time, but we do have some time available, few more minutes for any questions that people may have.
Thanks so much, everyone. There are a few questions. I'll highlight one that I see here in the chat coming from Nicole. Is there a benefit to your nonprofit to be an LLC? Can you all shed some light on that question and how that might play out?
I can run with that. So generally speaking, we see some 501c3 nonprofits or even 501c4 nonprofits set up an LLC. It may be for a specific program. Like, for example, if you opened a medical clinic, and you wanted to, have a reduction in liability, that could be a way to do that. The other way we see that LLCs come up is with housing organizations for funding. So they'll set up these separate LLCs for each new units or new building that they'll be doing, so that people contributing to their funding can get tax-free credits or tax-exempt status on that funding. So there's reasons that way. But generally speaking, those are the only times I see it personally. You still have to be a 501c3 or 4 to be a nonprofit, or there's different numbers too, 6 and all those different ones. But generally speaking, the charitable organizations are all 501c3.
There was one additional question about, do we only support nonprofits incorporated in California? And the answer is no, we do work with organizations outside of California. So if you have,
we also work with lookalike organizations. So you don't have to be a nonprofit to work with us. You can, on the insurance side, you can we'll work with anyone, but we stay in our lane basically. So
yeah,
if you're doing social services, related types of things that other nonprofits do, we can definitely help you with those.
Great. And one last question here. Can we get quotes from CalNonprofit Insurance Services to compare to our current broker?
We love that question.
Absolutely.
Yes.
Absolutely. Sure.
We'll actually do a policy assessment for you, so you don't have to get quotes to compare. You can give us all your policies and we'll help you to determine where your potential gaps are and make suggestions. So
great. And I'll point to one last question as we're running short on time, but this concerns foster family agencies, and we've obviously seen a big increase in premiums for those organizations. And Paula asks, if a foster family agency adds intensive foster care programming, will that increase insurance coverage?
Insurance costs, yes, and it may mean that you have more limited, people willing to insure you, organizations willing to insure you in general.
That makes sense.
So, yeah.
Great. Well, I want to thank everyone for joining us today. Thanks so much, Colleen, Cole, and Amy. I know we covered a lot of territory, and I'm going to include everyone's contact information in our follow-up email, which will also include a recording of the webinar and the slides that we've used today. So please do feel free to reach out to the folks at CalNonprofits Insurance Services. They will be more than happy to answer some of these more nuanced questions and spend time with you discussing your particular situation. I also want to thank everyone for attending. It's been great to see the engagement in the chat as well as in the Q&A. You joining us and bringing your own questions really does help expand the conversation and cover some of the more common questions that folks are asking.